Alright guys, so our big economic updates for you. We need to talk about the aid to Ukraine because the defeat at Avdiivka is sparking panic across the West. And with panic comes poor decision making, especially when it comes to monetary aid. Then we must cover China's big stock surge over the past week. It looks like investors are piling back into Chinese equities, prices are flying back up, and is it time to get back in? And lastly, the US deficit crisis is getting out of control. The day of reckoning is coming, and by 2033, America's debt crisis could be hitting an inflection point, a point where it's either an eventual default or massive money printing. And let's go through the Russian victory first because the calls for aid to Ukraine are growing louder and louder. While the US is bogged down in political deadlock, Europe is in big trouble too. France is struggling to pay for Ukraine aid as budget stretched. Macron has pledged $3 billion for Kiev and he's supportive of borrowing more money for Zelensky. And once again, we are seeing an EU country putting its own economy at risk to fight the Russians. France is tackling record unemployment, and the farmers' protests are getting progressively worse. Coming up with more money from their budget will be impossible, so the only way left is to borrow money and run out the debt burden in the EU. The desperation to turn the tide is getting very real. And in a stunning poll, we are seeing more Europeans beginning to realize that hey, Ukraine might actually lose the war. People on the ground want to push for a peace settlement, and the results of the poll are quite shocking. We are seeing a wave of war pessimism. Less than 10% of Europeans believe in a Ukrainian victory. Almost 20% believe that the Russians are winning, more than double that of Ukraine. And here's where things get interesting. Over 41% of people polled desire the EU to negotiate a peace deal with Russia. So public support, public sentiment is starting to wane. And remember, this poll happened before the fall of Avdiivka. So sentiment for peace deal today would actually be higher. And by now, I think we know where the Western leadership stands. The only option they can conceive is Russia to surrender completely and pull back to the 1991 borders. But we know that won't happen. So the only alternative left is to back Ukraine financially until the end. It's highly likely that aid from the US will eventually come. Biden is blaming the fall of Avdiivka on Congress. He wants the 60 billion, but by the time the money comes, it could be all over. And is the money really even enough? And let's break down the 60 billion that could eventually reach Ukraine. And you realize why, at the end of the day, it's actually the left pocket to the right pocket. The majority of the money is spent back in the US. Of the entire 60 billion provisions, only 8 billion will be to finance the salaries in Ukraine, to pay the officials and the soldiers, but the other 52 billion is used to buy arms, ammunition from US producers. It is used to replenish weapons drawn from US stockpiles and spent on services from the US military. It's basically writing a stimulus check for US manufacturing, right? It's like a mini bailout for the US defense industry. It'll help GDP growth just from this angle. It's likely that the funding could eventually get passed. Biden is using this to full effect. During a speech in Dallas, he re-emphasized how this helps US manufacturing and local jobs. While this bill sends military equipment to Ukraine, it spends the money right here in the US, in places like Arizona, where the Patriot missiles are being built. So what does this mean for you and me? Well, the inflation crisis isn't gonna end anytime soon. When you pump money to the war machine, you beat up the prices of everything, especially commodities. However, you don't increase the supply of things that truly matter. I'm of course talking about food and gas. That's just on the inflation side. War spending is also a very poor way to increase the amount of jobs. According to Brown University, military spending only supports 6.1 jobs per $1 million spent. Conversely, spending that money on healthcare creates nearly 12 jobs per $1 million. That's a world of difference. It's double the job creation. You can really see the big economic disconnect here. Sure, ramping up military spending for Ukraine will create jobs on US soil, but it's not the best type of job growth. There are other things you can really spend the money on. And on the European side, we can expect more money to be channeled into defense as well. Since Russia took Crimea in 2014, EU defense spending has exploded up. It went from $260 billion to $340 billion, and with the threat of Trump coming back, this amount will only continue to grow higher and higher. And with this increased spending, you can expect two things to happen. Either the EU economy slow down as they divert money away from their industries to military spending, or they get into bigger debt and borrow at higher interest rates. and either way, it's not a very good place to be. And if Europe plans to match Russia's defense spending, we better prepare for a world of debt and deficit spending. It's likely we are entering a world of perpetually high inflation, so don't be surprised if interest rates and inflation both stay above 3% or even 4% for quite a while. We are witnessing the trend of total rearmament that will last for years and even decades. But let's shift gears a bit here and let's talk about China, specifically their stock market. Are we at a turning point where things start to heat up? And by now, we know the narrative, right? That China is doomed, their economy has collapsed, and more importantly, they are uninvestable. Investing in China is like throwing your money to a black hole. From the peak of 2021, foreign investors have dumped the Chinese stocks, selling away 30% of their holdings. Now, that is definitely a big dump and it shows how bearish they are towards the Chinese markets. But sentiment is beginning to shift, and people are beginning to realize that China's stocks are severely undervalued. And this is the world's second largest economy. It won't just disappear overnight. China's stocks jumped to the highest in weeks as support measures mount. Foreigners have stepped up nearly $2 billion of Chinese shares from the lows, and we are now witnessing a reversal. The bounce up is about to erase all the losses in 2024, which means an increase of over 13%. So if you're invested in Chinese stocks, you will be sitting on quite a nice gain. But here's the trillion yuan question, right? Will this rally last? Will things crash and burn again? And to understand this, we must look carefully at the conditions of this rally. Two things are fueling this rally. The first is the biggest cut in their mortgage rate. China is taking steps to shore up their real estate implosion. Now, we must be clear on this. Property prices will likely continue to drop. What China is doing is to provide a soft landing and not a total collapse. They want a controlled demolition and not a disastrous crash. By cutting the benchmark rate by 25 basis points, this helps more cities in China to reduce mortgage rates for home buyers. The minimum payments go down and more people can take up loans. And this is a fundamental change, a structural change that will help slow the property drop. Obviously, Wall Street likes this, and that's why Chinese stocks rallied up. But we shouldn't expect China to cut rates by 100 basis points or 200 basis points or more. They are trying to shift away from real estate to high-tech manufacturing, so there is a physical limit to the rate cuts. China's second change is banning big players from selling at the open and close of market trading. This means institutional investors can't sell or short sell Chinese stocks during the first 30 and the last 30 minutes of trading. For example, a major hedge fund sold nearly $360 million in shares within a minute after the markets opened, and this move was probably meant to spook out the markets, and regulators, they didn't really like it, so they imposed this new ruling. And this is to prevent a big negative momentum from happening at the start of each trading session. It's a technical change and probably have very little effect long term. It's nothing structural, it doesn't really change the fundamentals of the economy. But it does help to stabilize the market, and it shows regulators are trying to stop the big boys from swinging the markets around. So good news for retail investors, bad news for the big hedge funds. And whether Chinese stocks rally further depends on investor sentiment. And the only thing they care about right now is interest rate cuts. So if China decides to slash more, then stocks will fly up even further. Now, personally, I expect this trading to be more range bound. China's shift to total manufacturing will take some time, but it is a good sign that Beijing is trying to prevent another stock meltdown. Let's move to our last update, which is the most frightening crisis of all. It's a train wreck that we all see coming, but things are accelerating really, really fast. In 2023, the budget deficit reached $1.7 trillion, a 23% jump from the year before. Tax revenues fell while obligations on Social Security, Medicare, and interest costs rose. And this is where we need to focus on the interest payments on the national debt. And to many of us now, this sounds very trivial, right? But there is a fiscal limit to how much the US can borrow before the music stops. And according to the CBO, the day of reckoning is coming. In just 10 years' time, the yearly deficit will reach $2.6 trillion. And this means to run the country, Congress has to borrow $2.6 trillion. But this next part should really shock everyone. This borrowing will hit 5.6% of GDP in 2024 and 6.1% next year. In other words, if deficit spending stops, the US economy will be in a horrible recession. Biden is borrowing almost double of America's annual GDP growth. So yes, President Biden can definitely postpone a recession in 2024 and even for the next 4 years as well if he gets re-elected again. All he needs to do is to keep deficit spending up. But he can't do this forever. And this projection from the CBO reminds us that you can run, but you can't hide. By 2033, the budget deficit will reach 7% of GDP. Remember, this borrowing has to continue or there will be an instant recession. But that's not even the scary part. In the same year, it's clear that interest payments on the national debt will outstrip all other categories of borrowing. It will overtake borrowing for social obligations and unemployment benefits. At what point does this become a default, right? When will countries stop lending to the US? Because the interest payments themselves show the debt can never truly be repaid. This crisis has always been a spending problem. Domestic outlays, which is spending, are projected to grow consistently for the next 10 years. It will hit 25% of GDP. However, federal revenues will stay stagnant at 18% of GDP. So this shortfall of 7% will continue to grow over time. Just from this chart alone, we can tell there are only three ways to solve the deficit crisis. The first is to drop spending, but that means a recession, and which president of the US wants to crash their economy during his term? And the second option is to increase taxes on the local population. Whether it's to tax the rich or to tax everyone, federal revenues have to go up, close the gap. But that is politically unpopular as well. If you raise taxes enough, you'll also crush economic growth. So the only option left is to print money. And I hope this is a good reminder to everyone about the end game. Whether we get a market crash this year or not, look further out. In the next 5 to 10 years, asset prices will continue to rise higher and inflation won't end. Inflation will be forever. So let's understand this landscape going forward. Even if Ukraine falls, this doesn't mean military spending will stop. Instead, things could ramp up to a whole new level because the perceived threat of Russia will only get bigger and bigger. And this will mean a world of higher rates and higher inflation, a world of continued economic sanctions and dollar weaponization. Even if there's a threat of recession today, realize that asset prices will reach new highs in the decades ahead. The value of the dollar and fiat currencies will continue to crash, and this is a one-way train towards a devaluation hell. But let me know your thoughts. Will Ukraine get their money? And is this a good time for Chinese stocks or just a false rally? Let me know in the comments below. Stay safe, be sure to smash the like button and subscribe as we navigate through these crazy times.